Aave liquidated in a few minutes for 200 million worth of collateral across multiple networks without any issues. What I like to see is that people start thinking about how do you preserve capital. And inflation is the worst enemy for every human in the planet.
Well, that's a good statement. Meet Stani Kulechov, co-founder of Aave, a leading decentralized finance protocol with billions in locked value. Stani has been at the forefront of DeFi innovation since its early days, building the technology that allows you to use your digital money to earn income or get loans entirely without banks. He's not just building protocols, he's driving the expansion of a truly open, permissionless financial system and helping to define the future of money itself.
If we want DeFi to scale, it needs to be very easy to use and accessible.
Nobody understands internet, but everybody is using it.
They can use it without understanding, and that's where we have to get DeFi as well.
What are you looking forward to?
That's a hard one because...
Stani, welcome here in Amsterdam.
Thank you, nice to be here.
I've been following you for a long time, and I should just one of our team members has been holding ETH Lent. And the first question that I wanted to ask was, it's been nearly 10 years since the first project started and the first idea has started. Is the vision that you wanted to go for back in the day still the same, and what has developed in that period?
Yeah, I mean, I recently, just for fun, I went and read the original ETH Lend white paper. So ETH Lend was before Aave. For a couple of years when we started to build decentralized finance on Ethereum, and a lot of things that I actually wrote there back in those days, still makes a lot of sense, which is kind of funny because typically you have a big vision and things you can actually do, and I try to be very descriptive about what you can do with on-chain finance, tokenization, even the concept of tokenization was there, that will bring a lot of value and will expand decentralized finance. So a lot of that is still there, and I think it's really important to kind of follow the original vision, especially if it makes a lot of sense. And seeing now Aave being growing and becoming kind of like a leader in DeFi, a lot of that vision still makes sense, and I think there's a lot of growth space at the moment. So surprisingly, it's been quite accurate.
It's been such a long period, and I think, 6-7 years ago, you were just building, experimenting, trying stuff out, and all of a sudden you are like one of the big blue chips in the space that is unlocking the next phase into DeFi and into crypto. How is it to just handle that sort of responsibility? Or it might not feel like that, but...
Yeah, I mean, it's it definitely, in the beginning, it's a lot of responsibility because, there is a company like Aave Labs, and, there's people working, engineers and non-engineers, and you basically have a lot of people focusing on the same mission, and you kind of feel accountability to everyone, to the staff, and also to the users, to the community, and overall to yourself. So, but down the line, as things starts to work out, and you can see that Aave effectively is a piece of infrastructure that just exists there. It's resilient. It works. So the idea of Aave as a protocol is to actually remove this sense of responsibility as well, and introduce with resiliency. So less central point of failures that centralized systems have, or centralized traditional finance, and also making kind of more like a fault-proof financial infrastructure. So that's how I feel about it.
And crypto is a pretty heavy roller coaster. Depends on what you do, but as an investor, it's a pretty heavy one, with highs and lows. And if you are a builder, I suppose you've got the same sort of periods. Mm-hmm. What is the moment that you are the most proud of in the past 10 years of building?
I think it's hard to pinpoint exact kind of a moment, but I do think that when we launched the first version of Aave protocol, that was really interesting, kind of like a time period, because that was 2020 January, and COVID started in expanding in Asia, and we were still going to events like ETC or at London Hackathon back in that year, and just sharing people what we built with Aave. And not that we knew, a couple months later you will have a full lockdown globally. At the same time, you will have central banks dropping completely interest rates pretty much to zero, quantitative easing, and DeFi started to become an opportunity because you have yield that doesn't exist in the traditional finance sense. So yeah, that probably was the biggest kind of like a moment that everyone went into their homes, found DeFi like the early adopters, and started to actually use our product. And I think that's for every founder. I think that's really a big thing when you see users using it and also giving feedback and asking different types of features to be added. I think that's the best feeling ever.
It's also, if we talk about the COVID period, it's such a weird time because for a lot of crypto people, it changed their lives in some way. Completely. The adoption just grew and came out of hand. And for DeFi, it unlocked an entire new market. And I think during that period, a lot of testing took place. Mm-hmm. And a lot of yield hunters came into the space as well with a lot of those protocols. What have you learned from the DeFi 1.0 period going into this phase where slowly but surely you start to see DeFi 2.0 or whatever it's called? It's just the next phase. But what came out of that first period or summer of 2020?
Yeah, I'd say that biggest learning is that the early users are very forgiving. So they're willing to take all kinds of steps and figure out bottlenecks to get access to the product and access to DeFi. And they're willing to, write seed words down and, create complicated strategies and have this like a complexity in mind. With this DeFi, and I think it's an interesting kind of like a time horizon now, because Aave is now the biggest DeFi protocol, so we have to go and see like where we get new audiences, and that's like a big kind of like a challenge for the DAO. So there's obviously two paths. One is the institutional path, and one is the consumer path. So especially big learnings are that if we want DeFi to scale, it needs to be very easy to use and accessible without compromising the self custodial aspect of decentralized finance, without compromising on governance, without compromising on transparency and so forth. So that is the biggest learning. The first users, they were okay with everything being so fucking hard. Okay, so the mainstream, if there is like a one bottleneck, challenge in the experience, they will just drop out and they won't engage with the product. And that's the learning we have here.
I think a lot of UI, UX needs to be improved still to get a lot of more people into the space, especially if you talk about institutions. I mean, even retail people are not going to plug into the MetaMask and try to get into a DeFi protocol. It's still, we're getting there, but back in the day, it was super hard to get anything going with all the mistakes that people make.
Yeah.
And then you also had the big pushback from institutions from the US or whatever country there is, especially after everything that took place with FTX and Celsius and the centralized parties. And now in the past, let's say 12 months, there's a sudden change in terms of the view that the US has on crypto, on DeFi. Mm-hmm. How is that changing the roadmap for Aave, and what is the most interesting part when it comes to the interest that the US has into crypto?
Yeah, I mean, what you mentioned about FTX and the centralized lenders, blowing up is something that's kind of like was unfortunate, but at the same time, that strengthened the idea why decentralized finance is important, and why we have to have a way of interacting with liquidity or other peers in a way where there's no kind of like a middleman or some sort of like a central point of failure. And I think when we started building Aave and Eatland back in the days, at the same time we saw a lot of centralized lenders come out, and we tried to raise funds. Obviously, we couldn't get any funds raised in the beginning, but we saw massive fundraisers happening on the centralized side. So we saw, obviously, we saw BlockFi, we saw Celsius, we saw Genesis Lending. So these companies had billions worth of loan books in a very fast couple of year period. So we decided to go the hard way. Like what would be the best kind of like an outcome for a user from this technology, and how do we make a good experience out of it? So obviously, like those days there weren't, for example, stablecoins even on Ethereum. So it was very kind of like a nascent environment, and then you had the challenges with like the browser extensions, and you have to go get then when stablecoins came, get stablecoins and then supply, and there's too many steps there basically. Yeah. And now kind of like what we're seeing is that all that centralized lending actually went on chain. So the actual behavior of borrowing against your crypto holdings didn't disappear. It exists, and it's just happening on chain in a more secure way and without middlemen. And I think that's the kind of like a realization of where we're heading at, and why this is kind of like so relevant. And now, we see institutions coming in, and basically there's more regulatory tailwind that's really helpful. And it has definitely changed the roadmap in the sense that we're now also trying to think that what the institutions want and how we can take the Aave as a technology, the protocol, and also apply to more traditional assets as well that are coming on chain. Because the technology is agnostic of assets and use cases.
That's interesting. I spoke with Sergei before, and he also is the most sort of bullish in terms of money market funds, tokenizing basically everything and putting that on chain and then using it as collateral, which we'll discuss in a little bit. But recently, which surprises me, especially when it comes to what we've witnessed with Luna and the stablecoins and the algorithmic stablecoins back in the day, is that all of a sudden the doors are opened for any stablecoin to exist. And we've got like 200 at this point, and either they are Bitcoin backed or they are whatever. More. Yeah, probably even more. But even algorithmic ones that have the same insecurities as back in the day. How do you see that develop? As in, it feels for me as if politics are just simply saying, well, just test it out, make it go fail, and then we just show the CNBC central bank digital currency, and then we go from there? Or is it just we try to make a digital stable coin out of the decentralized ecosystem and we take the best one? What's your current view on the stablecoin rises as a hot topic?
Well, I do think that the decentralized stablecoins are kind of like the right way of creating resiliency. And this is why within the Aave ecosystem there is Go, which is Aave native stablecoin. And the idea there is that came out of actually the users' requests, because the interest rates on the Aave protocol there are based on supply and demand. Basically, it has a kind of like a market-driven algorithm. And for borrowers, they want more predictability on the borrowing cost. So that's how the Aave native Go stablecoin was created in a very decentralized way. So it's over collateralized. There's liquidations and mechanisms to stabilize the peg that are well studied, well known, and already applied in the DeFi space. So I think that's great, but also to actually grow a decentralized stablecoin, you need enough collateral. So obviously we have crypto assets that can be used as a collateral. So Go is backed quite heavily with ETH or wrapped versions of, for example, Bitcoin. But down the line, if you want to scale a currency to billions of people, you have to have RWAs at some point. So that's the kind of like a angle. But you're still using smart contracts in a way where you create a resilient system and diversification of these collateral assets. And then when you think about these other stable coins and so forth, I think that I love the idea of being able to be having a low threshold of actually innovating and market participants to come and innovate and build businesses around this technology. I think that's the right way to approach. And also like that's where I want the regulation to also be, that it gives that space. But also if you think about like scales of economies of scale, at some point, bigger stable coins, they would just eat smaller ones and eventually there will be like a few bigger ones. But the key difference is that there's going to be always that opportunity to come and innovate and create something new, as long as it's sound, basically.
It's interesting that you're saying that, because if there is a regulation or if there is a framework that needs to be used to build in, it's less flexible than what it used to be.
Yeah.
Like when you were starting out, it's just like, I'm experimenting, I'll just see whatever happens.
Yeah, you just deploy some code.
Yeah, and then you're like, right now, for instance, in Europe, you've got the MiCA license that you need to use or have if you want to build a financial product, which increases the bar to just build something new. Exactly. What's your view when it comes to the regulatory framework that we have in Europe, but also that's being established in the US in sort of turbo speed at this point?
So, obviously like I've been in software since I was 13 years old. I've been doing web pages, web applications. I've been building fintech as well before going into Ethereum and DeFi. And but at the same time, I actually studied law as well. So I graduated in Helsinki, Finland, where I come from. So like I really love the kind of intersection of like technology and law as well, and trying to kind of like figure out how to ensure specific rules that allow innovation, but also creates a level playing field for everyone, and create some sort of protection that isn't really harmful for users in terms of like seeing lack of innovation. That being said, now looking at MiCA, for example, I do think it's probably I don't know what's the right word, but it isn't the best application of regulation for this type of technology, or not just the technology, but these services that are built around this technology. And to explain why is that MiCA basically was built around the Libra stablecoin that Facebook was developing, and it was based on a basket of currency model, which is a lot of MiCA regulation is written for. And that stablecoin never happened, and probably will never happen in a similar way. Like we probably won't see that type of stablecoin taking mass adoption. So then you already have EMI regulation for electronic money institutions across Europe. That regulates money that isn't held in physical form, that is held in digitally in databases. Now, blockchain is a digital database. The architecture is just organized in a different way. So essentially, now the problem is that you have a EMI regulation, and then you have MiCA regulation, which really focuses somewhat on stable coins, but broadly focuses on crypto. So the problem here is that you have crypto assets that are volatile crypto native assets. You have stable coins that are effectively RWAs that are just representing stable value, and you have RWAs coming. So we're kind of applying something into a use case that already kind of fits somewhere. So stablecoins could have fitted into that EMI regulation purely already. And then also the mitigations that you want to have with stablecoin, with crypto doesn't apply to stablecoins, reserves and whatnot, and other investor protection when you have stable value. So that's the kind of the challenge. So regulation helps to create and remove uncertainty and create a playing field where institutions are willing to work with the technology, but at the same time, the devil is in the details. And wrong type of a regulation can really hurt the small businesses.
Yeah, tell me about it. We are facing some issues as well in that regard, but I'd like to keep it positive as much as we can. I mean, ultimately, through the regulations and also the launch of the ETF, it's unlocking so much liquidity that's coming into the Web3 ecosystem, and it always takes a certain lag. So in terms of adoption, it's great. But there is also a lot of misunderstanding. And just before I told you that we were on stage 2 weeks ago and other people were claiming that RWAs are currently dying, which is a little weird to me, as in...
The person confused with me.
Well, I hope that they are dying down, to be fair. The question is that back in 2020, DeFi was really degen and just for retail.
Yeah.
And there's a lot of misunderstanding at this point. It's more driven by institutions, and RWAs are more out of reach for retail. Mm-hmm. Maybe you can explore or explain that. What are the biggest sort of misunderstandings right now when it comes to DeFi and RWA?
Well, biggest misunderstanding about DeFi is what DeFi is. It's basically an environment for all kinds of algorithms to thrive, financial algorithms. So Aave protocol is essentially an algorithm that is governed by the Aave DAO, which is basically collective of Aave token holders. The algorithm is basically has 43 billion worth of value in it and in net deposits, and it's revenue generating to the DAO, so it's basically profitable. That's actually very interesting because it's really hard to start up a company and make the company profitable, but try doing that as a DAO. Mm-hmm. That's even way more complex. So, and there's not that many DAOs in DeFi and overall where we see profitability and real product market fit. So that is an interesting point. But DeFi is this kind of a backbone of algorithms. And stablecoins, why they're needed is that it's the only way to access to decentralized finance and basically consume liquidity. So by collateralizing assets, you can borrow. Once you have the borrowed stablecoins, you can go do something in DeFi, or you can off-ramp and finance another goal outside of on-chain. And then it's a ability to extract the yield as well. So I would even argue that stablecoins are main use case won't be the stability or cross-border payments. It's actually going to be harvesting financial opportunities in DeFi, the most democratic way across the globe. Now, RWAs, so the third part, we have DeFi, then we have stablecoins and RWAs. RWAs is a way to scale DeFi because we have so much value that it is sitting outside of the blockchain, and it should be sitting inside of the blockchain. And if all the value that we have in the world moves to this new medium, which will happen, suddenly the size of Aave, the size of DeFi, the whole ecosystem grows by millions of percentages. And that's where it becomes really interesting because we moved from a kind of a financial medium of writing transactions into clayboards, then later into paper, and every medium gives new properties. Digital, it's fast to read. Everyone can read the information globally, access rights globally. And then last is on-chain, which adds security properties, access control properties, like how do we change an interest rate model in in Aave, for example, or the revenue model as an example, or what asset is going to be listed. So there's a lot of that. So that's why RWAs are so important, is that it's a mechanism with this tokenization to bring that value on chain. And in my opinion, it's better that it's on chain than outside of our world.
Why?
Because once it's inside, then you actually have ability to either borrow against it. You can swap the value. It starts to have economical properties, and not all value needs to be on chain. Obviously, there's certain things that it just doesn't make sense to, you probably won't see like every single property or every single piece of furniture or every single fund being on chain, because why bother if the traditional system works? But where you want to achieve better liquidity network effects, collateralization, there it becomes interesting. One big opportunity is just purely providing access. So how everyone could actually invest into companies that build the future, like SpaceX, Neuralink, or Stripe, which are available for private investors or secondary sales. But if you have that tokenized, it can be just one click transaction of buying the amount that you want. I think that's really valuable.
I think if we talk about that, then it's also a gap of knowledge. There are multiple platforms also in the Netherlands that try to fragment the investments that they do into private companies.
Mm-hmm.
But then you basically figure out that retail investors are usually not really looking into those investments because it's too hard to grasp, or it takes a lot of time. And the thing is more of institutions jumping into on-chain to provide additional liquidity, or you can use it, or have it as collateral, and then it's easy to transfer. Or there are a lot of doors that can be opened. But if we talk about the expansion of DeFi, then it's going into exponential curves. Mm-hmm. We had one in 2020. We are on the edge of the next exponential curve, I feel like, hopefully. But what do we need to basically onboard the next billion users?
Yeah, I think what we're going to see is basically Aave as a protocol is going to get integrated into more kind of centralized finance. So we'll see exchanges basically being using DeFi and Aave as the backbone. Then we will see fintechs as well. So once the yields starts to go down, so obviously we're now here in Amsterdam, we're in Europe. So, if you go to a bank, you probably get, let's say you go to a fintech, you probably get a interest rate account, maybe slightly above 2 or most likely below 2. And if you go to banks, you get very little. If you withdraw your funds more than once, they slash your interest rate. So, they can have all kinds of weird terms of conditions. But basically, the more central banks are lowering the central bank interest rates, the more bigger the DeFi opportunity will be. So European Central Bank is already doing that. Bank of England started already, been lowering interest rates for almost a year now. And eventually Fed in the US will have to do that because people can't pay high interest rates for mortgages, car loans, credit cards, and business loans. At some point, it becomes costly. And that slows down the economy because less people are investing, and we end up in a situation where we're trying to avoid inflation, but we're having a risk or entering into stagflation. And that's the worst possible because the economy isn't growing at that point. So what I think is then happening is that then you are seeing the DeFi opportunity bigger. So we go back to that earlier example, what I mentioned when it was COVID and rates were down. DeFi felt really good because you could get 3%, 2.5%, 3.5%, and obviously later with DeFi Summer, we saw all kinds of two-digit numbers. But the main point there is that at some point that will happen, and we'll see the benefit of DeFi, and that attracts more liquidity, more consumption, and I do think that the asset managers are key role here, because normal users can access DeFi. There's still bottlenecks, but we will see a lot of traditional capital coming to asset managers that will just package the opportunity and provide for their own audience.
Yeah, I mean, during the COVID period, I switched my house, and in hindsight, I was able to get it on the lowest point of COVID, or at least started renting. And a few weeks back, I was checking the price of the property to potentially buy it, to get a mortgage. It's insane how much that just started to grow.
Completely different picture.
Yeah, and even renting prices are up like 80% since the low in 2020, in Amsterdam at least. It's insane.
That's the inflation, and that's part of that quantitative easing. And also, like, this is why the space exists. It goes all the way back to not just the blockchain, but Bitcoin as a way of storing value. You know, Ethereum as the internet computer, and DeFi as the financial kind of operating system and algorithms. So going back to that, inflation is the worst enemy for every kind of like human in the planet, because it's the kind of easiest way to move value out of large group of people to something else, whether it's basically the stock exchange or directly to government by issuing credit or some other means. And when we think about like the future, what I like to see is that people start thinking about how do you like preserve capital and how you actually form capital and try to avoid, because inflation probably will be the only tool that governments can actually wipe out a lot of value from large group of people, and that's the kind of like a suffering party.
It's I don't really want to dive deep into this, but if you really think this through, then the fact that there is inflation, it pushes people into taking more risk.
Of course.
That's like in the Bitcoin books and everywhere, it's just written down that if people can start planning and saving because they know for sure that their money is still the same purchasing power in 5, 10 or 20 years, then life becomes more relaxed. Probably societies are more friendly to each other. Yeah. But that's a whole different topic. Talking about Aave, it's ETH V1, V2, V3, and now we're in V4.
Yes.
That's like if you iPhone 15, iPhone 16, it's kind of like that. But
the big difference is that if you look at the previous iPhone releases, nothing much really changes. Like it's very like a small, but we have like a generational improvements in these lending protocols.
Well, if we talk about that, what's the biggest breakthrough in V4?
Yeah, I mean, V4 is new architecture, effectively improving the capital efficiency. So typically in the existing Aave V3, you can create new markets. And the issue with these new markets where you have like a segregated collaterals and an asset is that you always have like a chicken and egg problem. So in V4, you can create as many assets as many kind of like in V3 it's called a market, but in V4 we have this concept of liquidity hubs and liquidity spokes. So liquidity hub is where liquidity is stored when you deposit assets, but the liquidity spoke is kind of like the configuration of what you can borrow, what assets are listed, and you always come into the pool through one spoke. So effectively, you can create different kinds of spokes that are configurations. So one could be you can only borrow, let's say, wrap BTC and ETH on this particular pool against stablecoins. The next spoke is you might have like a more long tail assets. Third one can be RWAs. And when you create these new spokes, whether it's created by the Aave Labs team or anyone from the community or third parties, the liquidity hub can give a credit line to each spoke. So it removes the whole like a chicken and egg problem that every liquidity pool has. People want to borrow, but there's no liquidity, so someone needs to go and seed it. But with the liquidity hub and spoke model, you can basically just give a credit line approved by the Aave DAO, and you have liquidity there, and it kind of like removes all the issues with liquidity bootstrapping. And also you have spokes where you have segregation of risk. So you get rid of also you add segregation of risk without reducing the capital efficiency and liquidity network effect. So it's basically just kind of like having much more capital efficient system. And capital efficiency, even a little bit, can help to grow the liquidity and make Aave more successful. But the amount of capital efficiency we're adding now is unprecedented.
I think if we talk about capital efficiencies, it's about percentages, and ultimately reducing costs, increasing the potential return. Yeah, which for a retail investor doesn't really make much sense, but for institutional investors, it's a big step forward.
Yeah.
To become more attractive for them.
Yeah.
If that's.
And regarding the cost, we have another feature that is called risk premium. So when you borrow from Aave V3 today, whatever asset composition you have, you pay the same price of the, let's say, USDC or Go borrowing. In the future, if you have the leanest collateral, you just pay the base rate. And if your collateral composition is more complex and riskier, you pay a risk premium that is kind of depending on that collateral composition. So what it means that we can provide the best rates to borrow if you are on the less riskiest side of the spectrum, and also price the risk accordingly if you are on the riskier side. So there's no kind of like a free riding with borrow costs, which is great for what you mentioned about the pricing of liquidity and being more efficient there.
How do you, for people that are listening and are also learning about DeFi, understanding how this works, how is such a risk premium established within the ecosystem, within Aave? As in, you have less riskier asset, but also riskier asset. I saw something like risk premiums differ per certain stablecoin.
Yeah.
How is that measured?
Yeah. It's basically every asset has its own kind of like a risk configuration, and depending of those collaterals that you have in the system, we basically have an average of those positions depending on the size of the collaterals that you have as a collateral, and then we calculate the number, and then we add that to the base rate. So it's pure mathematics basically.
Yeah, super complex for anyone that's
complex, but at the same time quite simple in the sense that once it's there, you can apply it to any asset. You just have to have decision of what each asset should have, like a base risk premium, and that's the job of the risk service providers who are contributing to the Aave DAO that are actually like kind of like managing the risk of the whole protocol.
How big is the Aave ecosystem right now?
Well, there's, I would say, 200,000 token holders, which from like one part is quite active, and out of those actives, they're delegates. So Aave DAO is kind of based on like a liquid democracy where you can, if you own Aave, you can delegate the voting power and the governance power to a delegate that is actively then participating and voting. Because there's a bunch of people that don't want to go and vote every, a couple of times a week, and voting doesn't scale to everyone if you do it often. And then you have service providers. So service providers, there's roughly like a half a dozen that are actively just providing certain types of services. So Aave Labs, we're one of the service providers. We develop software development. There's another team build software. There's two teams providing risk management services. There's a governance service provider and more kind of like finance type of a service provider. So it's like a really decentralized collective of different type of community members.
Another thing that you have integrated into, or at least is integrated into Aave V4, is the fact that there's an own layer 2 built on top of Ethereum.
Yeah, that's in the original Aave 2030 proposal. So what we're thinking is that what comes now after. So obviously now we're focusing on shipping the Aave V4, also expanding Go, the Aave native stablecoin, to new networks. It's already on L2s like Base and Arbitrum, and now we're focusing on expanding to Avalanche as well. And then Aave network is effectively what we've been planning. That could be a continuation of kind of like how we could store liquidity efficiently across different networks. But that's still in a proof of concept type of a level.
Yeah, I was about to ask, as in right now, actually not right now, but in the past 5 years, the sudden surge of layer 2s has, well, layer 1s initially and now layer 2s have significantly increased. And first of all, there's the question of whether we need all those layer 2s. And then the second question is that it's not only EVM-based DeFi, it's going to be on multiple chains, or at least multiple ecosystems are trying to build their own DeFi. Sui is doing it, MoveVM we've got right now.
Yeah.
How is Aave going to like integrate that all together, all the liquidity?
It's a great question, because the power of EVM is that not just the network effects and security that you get from Ethereum, but also the fact that with EVM, you write the code once, and then you can deploy it on every EVM. And if there is no significant changes in the underlying network, things work well. Now, with non-EVMs, you obviously need to write the code based from scratch. And that is a big pain in the ass, because writing a secure smart contract protocol, especially where you have collateralization, is one of the hardest things to do on chain. It's a very rigorous process, and we've seen during DeFi summer that you can build something really quickly, and it might have flaws, or you take something that already exists and fork it and change parameters, and you introduce some sort of exploit. This is something that happens frequently and creates issues on when it comes to forking. So with these non-EVMs, Aave is already building a Move implementation of the Aave protocol V3 on the Aptos blockchain, and that is already the development work is done. We have a couple of security audits done, and it's now in a security contest. So hopefully we're going to launch it very soon. But that's just like our first kind of like a project going outside of EVMs and building it there. But as we saw, like, for example, in Sui and some of these other ecosystems, is that it's really hard to build very secure DeFi. And I think that's how Aave has created its brand, because that's where the focus is on the safety and security and scalability.
Isn't that also the case for Ethereum in general?
Yes, of course.
I mean, Ethereum is the most secure, compliant chain out there.
Yeah.
But it's not really getting the recognition it deserves.
No, and I think it's because, people want to see action, they want to see entertainment, they want to see progress. Yeah. And previously, not a long time ago, people were complaining that Ethereum doesn't scale. With the L2 scaling strategy, it actually scales, so you get less fees, but you get more block space. And now, people aren't happy for that, so they want to see, more scaling on the L1 and direct block space. So it is fair that, and Ethereum, by the way, Ethereum has been progressing. There's been the merge and a lot of good updates recently in the past. So it is kind of like a progressive ecosystem, especially when you think about like how much value is at stake and how many institutions and DeFi protocols are actually holding the value there. So it's not a joke, definitely, to do any kinds of updates. So, but I do like the new vision of actually like scaling more the L1, making Ethereum as a stronger value proposition. And I think that will resonate to a lot of people. But Ethereum still is, and it's going to be like a really kind of a strong network to build, especially if you're building DeFi.
Yeah, well, I mean, recently I think it's called Pectra,
Yes.
the big upgrade, and the day after the announcements from Stripe came in, that it's using or you can use stablecoins within Stripe, and they are using Ethereum blockchain for it. As far as I understood, my birthday was on that day, so I might be blurry a little bit. But what is that telling you? If those big entities are jumping in to use stablecoins or integrate anything related to Web3 or blockchain?
No, it's a huge statement. I mean, and it makes sense because that's the most trusted technology, and it functions, and it doesn't have downtime. So it is a big statement, and I think also it's a progress for a lot of these fintechs to recognize as well that what is the benefit of stable coins, the blockchain, and what you can actually achieve. So we're moving forward with that part, and also seeing more institutions like BlackRock tokenizing their funds and bringing on chain, being like a really big social proof for the whole, not just Ethereum, but also like the DeFi and the on-chain space.
And I think that's the first step, but Aave keeps on innovating. And I think the next step is that we can use RWAs as collateral. You've got the stablecoin Go.
Yeah.
Probably not really familiar with the audience, so maybe you could explain what the stablecoin Go is and what the next level is when you talk about RWAs as collateral.
Yeah. I mean, Go is over-collateralized stablecoin. So effectively normal like centralized stablecoins like Circle or USDT from Tether, they're usually backed by 101 by, let's say, treasury bills or other types of investments that are happening off-chain. Go is fully backed by on-chain assets, so that's effectively Ethereum or ETH-derived assets like staked ETH, wrapped Bitcoin, and so forth. So it's a more kind of like a resilient stablecoin, and it has a liquidation mechanisms and peg control mechanisms that are really like proven in the DeFi space, and they work really well. Historically speaking and statistically. So, and Go is expanding to other networks now, and why Go is important for the Aave DAO is also that 100 million worth of Go that is issued, borrowed out actually by the borrowers on Aave, is yielding the same amount revenue to the Aave DAO as 1 billion USDC. And that's because Go doesn't have LPs in that sense when it's minted directly to the pools. So that's a big thing. And then real world assets. So Aave is launching Horizon, and Horizon's first initiative is a RWA market where you can use permissioned assets as a collateral, like BlackRock's Biddle Fund and a few other examples. And then you can borrow stablecoins. And this is a kind of market where you don't see only money market funds tokenized and used as a collateral, but other types of things. So credit funds, we'll see also ETFs that will be tokenized, equities, and so forth. So it's a first step of actually expanding Aave beyond like the crypto native assets to the assets that we know in traditional finance.
Quite recently, I don't know which exchange it was, but we saw the first like tokenized stocks.
Yeah.
Well, yeah, but back in the day, FTX also tried to do the tokenized stocks thingy. Didn't really work out, but that is probably what we're going to see next.
Yeah.
Stocks, commodities, all those things being tokenized put on chain to be able to trade it between each other.
Yeah.
While there's also a thing like real estate that we try to tokenize, but a lot of projects are trying to do it, but it doesn't really work out.
No.
What is missing in those like tests that they are trying to achieve? As in, some big guys are trying to do it, but they are not yet launching a token or.
Yeah, I think a lot of projects put the cart before the horse, so to speak. Like, I don't know what's the saying, but that's how we say it in Finnish. But basically, I think the best way to tokenize real estate is to go where the liquidity is. And that's where, like, in my opinion, that's rate markets. So already kind of like real estate funds that are traded in an exchange and tokenizing that and bringing that on chain. And that brings additional value, utility when you can borrow against it. In Aave, as an example, during the weekend when no other bank would allow that to do, or in the first place. So that's one way, starting there, and then like slowly moving to being more opportunistic and down the kind of like a liquidity curve where you have less liquid assets and then tokenizing them at a scale. Not particularly like you can't go and just pick up one like a piece of real estate or let's say like a hotel. Like you have to like have scale because you want to create liquidity and that's where like you need concentration. So that's the probably like a most scalable way to do it.
It's interesting as a lot of real estate projects are trying to tokenize a single property and then fragment it. And that's where the problem starts to kick in, because you can make a DAO, but then still there are a lot of factors in like impacting anything on the property itself that's not included in the DAO. So I think we're not that far yet, but like REITs and stocks and all those things can be tokenized and making it more liquid and more accessible and probably providing a bigger yield. But now if we talk about yields, I know I've been to your speech panel with Sergey in Singapore. You were, back in October, you were talking about rates to go down or yields to go down. That's going to positively impact DeFi. It's not really happening yet in the US.
No, it's Europe obviously, and I think it would happen in US earlier if the whole like a tariff war wouldn't happen. So the only thing that Fed is actually able to do at this point is to postpone. But you can't really postpone forever, because as at some point the economy starts slowing down, you see less spending, less inflation. You enter into a territory where you have to act fast. And if you don't do that, you can endanger slowing the whole economy. And that's a bigger risk than lowering interest rates too early. So we already see this happening in Europe and in the UK. Rates are going down. Europe is lowering their rates, I think, tomorrow. I'm pretty convinced they will do that. But yeah, I think Fed probably can keep up the rates high until September, but then we'll see some cuts. They will have to come at
some point. I hope so. Yeah, I mean, Japan is currently raising the interest rates.
Yeah, Japan doesn't have any choice, because the economy isn't moving anywhere. It's been like this for decades now, Japan has been, yen has been used as a kind of like a carry trade instrument. You get pretty much free loans from Japan and you convert it to dollars and invest in other projects. So the economy is really weird at the moment.
I mean, the currency is completely destroyed as well. So they have to get it back up, which is kind of the same with China.
Yeah.
It's an interesting dynamic. If you compare the Chinese renminbi to the EBC chart, it's like a copycat of each other.
Yeah.
It's funny if you look at it from that perspective. But I wanted to ask, like, if a big liquidation happens in the markets, back in the day, were you checking whether Aave was still surviving during those periods, or?
Well, now when it happens, most likely I'm sleeping, or I'm because typically like the biggest event has been happening when I've been sleeping. Obviously, some other people on the team are awake, but in the market downturn when the whole tariff war started and the markets dropped by 20, 30, 40% some assets, and even the equities dropped significantly. Aave liquidated in few minutes 200 million worth of collateral across multiple networks without any issues. And I think that's a big statement, like how you can build resilient financial system that like anyone can enjoy, and not like centralized systems, companies running loan books with closed doors without any transparency. I think like this is why DeFi will win.
Well, that's a good statement. If you were going to go back with a time machine to 2016, and with all the knowledge you have right now from what you've built and the experience you have built up in the past 9 years, if you got the opportunity to rebuild ETHLand or Aave, what would you do different? If there is anything.
That's a hard one because the whole space kind of like matured. Like Aave and ETHLand changed because there was more DEX liquidity, so you could pool assets together and create combined cross collateralization. I don't know. I don't really know what I could do different. Maybe spend more time on like focusing on the UX problem as well, because I think that's been one of the slowest ones that are moving, and it's getting better, but we're still not in a place where every single person can go into Aave, like app.aave.com and use Aave. We will be there. We have to figure out like how to make it easier to manage your keys, your connectivity, and that kind of thing. So I think we'll get there.
I think ultimately, if my parents don't know that they're using blockchain while using blockchain, that's probably where we want to go.
Yeah, abstraction.
Yeah. And I mean, just before we went on this podcast, you said we want to be the HTTPS, which is kind of the same sort of, and then, comparison. Like nobody understands internet, but everybody is using it. Maybe more people need to understand it, but
and they don't need to. Like they
that's why
they can use it without understanding, and that's where we have to get DeFi as well.
Yeah. Final question. What if we look for the next few years, what excites you the most about the Web3 space? What are you looking forward to?
I think new audiences, consumers, definitely, and institutions. But also, I would like to see credit systems being built on top of Aave, and actually under collateralized loans. I think that will be amazing because every credit rating system, credit system in every country at the moment sucks. They're so horrible. So I think that a blockchain-based system that is leveraging DeFi will create a better outcome. So those are the things I'm excited about.
Good. Well, if anyone wants to join the ecosystem, they can simply go to aave.com, or are there any other connections that they can make with you or either with the team?
Aave.com and governance at Aave.com is where the whole community is. There's also a Discord. So those are the good channels.
All right. Well, thank you very much for coming to the office in Amsterdam.
Yeah, happy to be here.
I think you're going to Cannes for ETC, right?
Yeah.
Well, looking forward to seeing you there on stage again, talking about DeFi and everything that's happening, probably with Sergey. Thank you very much for coming by, and I'll see you again.
Thank you
Good luck
so
on
much.
the journey.
Thank you.
Thank you.